Please take notes. While trading can be rewarding, it comes with high level of risk and you can lose all your funds. And also note that videos on this channel are for educational purposes only. None is intended as investment advice. Please do your own research and also consult your financial advisor if you need one. Thank you. All right, so welcome back. So in this lesson, we are taking care of fundamental analysis in Forex trading. Fundamental analysis in Forex trading. Now, when you hear the word fundamental, uh, the word, that keyword stands for foundation. That means it's very important, it's very critical. All right, so fundamental analysis, foundation analysis. Okay, so let's quickly head on to clear this. So, what is fundamental analysis? Fundamental analysis involves evaluating economic, social, and political factors that can influence currency values. They can affect currencies of any country at all. So, and the analysis helps traders understand the underlying reasons for currency movements. So, when you are trading or you're about to trade and you see massive moves, don't just want to jump in. Pause first. Check through the fundamental landscape. Okay, check through the various sites, Bloomberg, RTT News, Forex Factory, FX Street. Just go ahead and look around on the internet and find out why the move. Because when you understand the move, or the reason for the move rather, if you understand the why, it builds your confidence for whatever position you are taking. Do you get the point? So, assuming that the fundamental news that came out actually is fueling a bullish trend for that instrument you want to trade. Maybe it's gold or any instrument at all. So, and price is coming down, is bearish. Do you know, guess what? You begin to look for support level where you can now enter in on that bull run and then follow the big banks, follow the big investors to ride on the trend. So that's why you need to always find out why the move. Fundamental analysis helps you to find that out. So let's quickly consider the key economic indicators. Now, economic indicators are statistics that provide insight into a country's economic performance. And some of the most important indicators include gross domestic product, GDP. So what is GDP? GDP is an indicator that measures the total economic output of a country. Whatever the country produces and exports and pushes out to generate income, that is gross domestic product. A growing GDP typically strengthens a currency. Why? Because as the GDP, as the country is producing, right, goods and services within the economy, and they are selling them outside or within the country, okay, the country is generating income, whether it's foreign exchange or even local currencies. So GDP is not only what is exported out, but as it is being produced, citizens also buy and they go back. So as businesses are really doing that, all these things are happening. That's why production fuels GDP. A country that produces over time begins to have high GDP, which or on the other hand begins to impact on the strength of the currency. Of course, you now say that the economy is doing well. Another economic indicator is employment data, unemployment data, and reports like the Non-Farm Payroll (NFP) in the US, which indicate job growth and economic health. They are part of economic employment data rather. So when there is higher employment level, there will be currency appreciation. So higher employment levels can lead to currency appreciation. Another indicator is inflation rates. Inflation rates, and these are measured by the Consumer Price Index (CPI) and Producer Price Index (PPI). When you have higher inflation, when a nation, an economy, a country has higher inflation, this may lead to central banks of that country, of those countries rather, raising interest rates. And as interest rates are raised, the country's currency will be strengthened. Why? because investors will be attracted. Now, if you have heard about carry trade before, carry trade is when big or high net worth investors put their money in banks to collect overnight interest. So when they see that the interest rate for let's say for the US economy has increased, investors will swiftly move their funds to US banks. And guess what that does? It begins to strengthen the economy because they will begin to collect higher interest rate for their funds. Because you see, billionaires have idle funds. So, and what these funds are doing is just so when you see when money works for you now, so they begin to move the money from bank to bank, from country to country. So they or their job is to just be studying, reading news, reading papers, looking for countries that are going to increase their interest rate and they'll move their funds ahead of time so that as interest rates are increased, even some after it's increased, they'll start moving. They'll start moving. Some may hear it a day late or a week late, and they'll start moving their funds and they begin to make money on the overnight interest rates. Now let's talk about interest rates. I'll use the inflation rate to also talk about interest rates. Okay, but that's still cool. Central banks set interest rates, which influence currency value. Higher interest rates offer better returns on investments denominated in that currency, attracting foreign capital. So I've already explained it. So let's move on. I went ahead of my time. So let's quickly consider central banks and monetary policy. Central banks play a crucial role in forex markets by controlling monetary policy, including interest rates and money supply. Traders closely monitor central bank announcements and policy changes as they significantly can impact currency values. How about geopolitical events? Geopolitical events, political stability or instability, elections, and international relations can affect currency values. You know, just look at what happens across the globe when elections are coming up. Go and check what happens in those countries. We just had the German election a month ago, so and go and see how it impacted on the euro. All right. So events such as trade agreements, conflicts, or changes in government can lead to volatility in the forex market. Market sentiment. Market sentiment refers to the overall attitude of traders toward a particular currency or market. Attitude. It could be bullish attitude, it could be bearish attitude, it could be neutral attitude. It can be influenced by news, reports, and economic data releases. Understanding market sentiment can help traders anticipate price movements. All right, so that's where we'll draw the curtain for lesson 1.5 on fundamental analysis. Go ahead and watch the next video on technical analysis. And I believe you have learned a thing or two from this. If you have, go ahead, like the video, leave a comment, your question, leave it in the comment section. Or you can also ask on one of our platforms if you have joined. If you have not joined, check in the description of this video for a link to join our Telegram channel where we deliver trading signals free. Yeah, free. They are free, and our signals are doing massively well. You want to join us and build your account if you have not yet. All right, and of course, if you are new, like this is for beginners, open a demo account and demo trade these signals for 2 weeks. Thereafter, open your live account and start making money. Okay, hit the subscribe button also, please, and also smash the notification bell because I'll be dropping the next video shortly so you can learn. Risk disclosure. Once again, all materials they have been presented with here are strictly for educational purposes. None of them is intended as investment advice. So whatever you put into the market is at your own risk. Be wise. Thank you very much and see you in the next video. Thank you and God bless you.